Hello, everybody. This is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, August 23rd, 2025. I really appreciate you coming by and spending some time with me with my weekend review podcast. I hope you're doing well. I hope you had a good trading week. I hope you are enjoying your weekend, and I also hope that today's podcast is going to be helpful for you and that you're going to learn something of value. So, Interesting week last week. Market had gone down. We had a big rally on Friday, so that helped the bull case. And in this podcast, the format for the podcast today is first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the positions and the trades that I made last week. We're going to talk about when I entered the trade, why I entered the trade, what the setups were, what the confluences of signals were, and what ultimately uh, got me to enter the trade. We're going to talk about how I position size based upon the volatility and my account value. We're going to talk about where I place my emergency stops, where I place my end of day stops, how I take partial profits if the position goes my way, how I'm going to go into trailing stop mode, and then ultimately how I am going to exit the position. So hopefully it kind of give you a good idea of how I view trading, how I look at trading, and how I set up my trade. So when I enter the trade, why I enter the trade, and really most importantly, how I am going to manage the trade after going forward. We're going to talk a little after that. We're going to talk a little bit about trader psychology. Everyone in trading, they're always talking about what's the system they use, what are the setups they use, and yes, this is definitely an important thing to have a plan. But it's more important to follow your plan than what the plan is. There are lots of different trading approaches that you can use. But if they're good ones, they're going to consist of looking for rejections of certain levels, being in support levels, and then having a good risk to reward. So if you're wrong, you can get out quickly, and if you're right, you have the potential for a large trade. So this all sounds good, right? Sounds like a trading approach, right? Of something that we want to use. Yeah, cut those losses quick, let those winners run. But if you have a plan for that, but don't follow the plan, then what good is it, right? So, I talk about this every week. Everyone, you need to get yourself a trading process, a trading strategy. You can get it from me, you can get it from someone else, but the most important thing is that you follow it. And whatever it takes to follow it precisely, laser beam focus on following your process, that is what is going to help you become a profitable trader, right? A long-term profitable trader, as they say. And that's everyone's goal in this business. But I'm just telling you very simply right now, if you want that to happen, and I'm sure you do, then you must follow your trading process. That's it. So we're going to talk a little bit of, that's a long way of saying we're going to talk a little bit about trading psychology, because trading psychology is just basically following your process. After that, I have gone down through my master watch list. I go down through it every Friday night, and I go through each symbol one by one, and I identify some potential trades for next week. Now, these potentials candidates are not there yet. If they were there already, I probably would have already taken the trade, right? But they're in the ballpark. It's possible next week that these could trigger. And I'll explain what I'm looking for. I'll explain if they get to these levels, what the confluences and combinations of signals are. So again, I hope this will be helpful for you just to get an idea. It's very important. A big part of my trading has to do with the weekend. Friday nights, go through all the symbols. Look for the setups that I'm looking for. Oh, look, this one is getting close. Not there, but it's getting close. And if it does get there, it will have this, that, and the other signal that will be lining up there. Now, if they don't get there, I just don't take the trade. Does that happen sometimes where they don't get there and they take off? Of course it does. It always does. But on the other hand, there's a lot that always get there. And even if they get there, it doesn't mean it's going to be a profitable trade for me, but it's the trade that I want. It makes sense. The structure is there. You have to be able to structure your trade based upon the signals and the levels that you have. And that's all the control that you have. Wait for the signals to line up, take the trade, and then follow your process. That's all. So anyway, if anything you find today in this podcast is of value, I really would appreciate if you could hit the thumbs up. It really does help out the channel. Lets YouTube know that there's some valuable content here. And so that I can get it out to more people. And if you haven't subscribed, I would really appreciate if you could subscribe as well. So let's get this U.S. legal disclaimer out of the way quickly. And as soon as that's finished, we'll get rolling. So hang tight. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, thanks for holding with me through that, and let's get started. So first off, current position is Netflix, NFLX. I entered NFLX here on the 7th of August at 11.81 even. Now, why did I enter this trade? This trade is what is called a bullish order block, one of my favorite, absolute favorite setups. It gives you such a good risk to reward ratio. So you see the top and the bottom of this green block. So let's go back in the past and I'll show you why this order block formed. And this goes all the way back here to 529.25. This is your order block. Why is it your order block? Well, with an order block, what you are looking for is you're looking for a swing low. Here's the swing low here, followed by a swing high here, followed by a lower swing low here. Now, once you have that in place, a swing low, a swing high, a lower swing low, you need to reference back to the swing high. And in the future, if you can take out that swing high to the upside, like we did here, right? So here's the swing low, here's the swing high, here's the lower swing low, and then this bar here takes it out. Why that's important is that now we have changed market structure back to the upside. Swing low, swing high, lower swing low, market structure change. And once that market structure change happens, now you can define your order block. Your order block is your lowest bar close before market structure change. So this is certainly the lowest bar close. This closes here lowest before market structure change. Now, when the market structure changes to the upside, I don't buy the breakouts. I mean, here it would have been just fine. I don't buy the breakouts. What I am looking for is I am looking for pullbacks now into the order block, because when you change structure to the upside, you're looking to buy dips. If you change structure to the downside, you're looking to short the rallies or short the rips. Now, let me kind of throw this at you here. So here we have an order block, and you can see a month later, we were much, much higher. So I think we could say, looking back in time, that the people, the traders that were buying in this location, that was smart money, clearly, right? In hindsight, when it's up here and you have this big down bar here, you can say, yes, people that were buying here, it was smart money. So in the green, instead of calling it an order block, which it is called an order block, but I also like to call it a smart money area. So if and when in the future we get back down to this area, this smart money where the smart money bought prior, well, it gives you a better chance that that level is going to hold again. Doesn't mean it's going to, certainly, but there's a better chance. And you can see even right here, I didn't take the trade right here, but when we pulled back into the smart money area here after the order block had formed, was that a good dip to buy? Certainly was. Okay, so here's the order block, the high and the low of this bar, the lowest bar closed before market structure change. If you take this into the future, like I said, I'm looking to buy a dip into that order block. Well, that's exactly what happened. So we came back down into the bullish order block. Now, when you enter order blocks, there are several different ways you can do it. Excuse me. You can buy with rejection of the high of the order block. You can buy with the rejection of the low of the order block. I entered the trade here on the 7th of August because the day prior we closed into the order block, and then this day that I entered the trade, it again went below the order block and then closed back in the order block. Excuse me, I've had this cough, dang it. So I entered here 1181. Now, as soon as I enter, or when I decide to enter, I have to decide to myself, obviously every trader does, how many shares of this position am I going to buy, right? Position sizing. So I use a very simple formula that it's simple, but it takes so many things into consideration. And a lot of traders don't do this. Adjusting your position size for the volatility of the market. If the market is more volatile, then it's going to be expected to move more. You need to buy fewer shares. If the market is less volatile, then you can buy more shares. So this is the formula that I use, and like I said, it's quite simple. The first thing you need to know is how much is in your trading account. Let's just say you have $100,000 in your trading account. I use 1% of whatever I have in my trading account. If I have $1 million, it's 10,000. If I have 100,000, it's 1,000. So let's just assume I have a $100,000 trading account. 1% of that is $1,000. Now, after I have this number, this is the most that I'm going to be able to lose on this trade. Okay, so the next thing I do, I take a look at the value of the current 2 ATR. This is average true range 2. This is twice the average expected range. And the value here is 53.42. So I take 1% of my total trading capital divided by the value of the 2 ATR divided by 53.42. That tells me to buy 18.7 shares, or in other words, I'm going to round up to 19 shares. Okay, so based upon the current volatility of this particular market and my account size, 19 shares is the correct amount. Now, my maximum allowed loss on this trade is $1,000. And so I'll show you how I set that up. So I entered here with the rejection of the bottom of the order block back into the order block. Now, first thing I do after I enter, we talked about the 2 ATR, I place my emergency stop, whatever the 2 ATR is below me. So if I have 19 shares and it goes down 53.42, how much am I going to lose? Well, we just did the math. It's $1,000. Now, the good news is this emergency stop that I placed 2 ATRs below my entry, that's only going to trigger about 5% of the time. The other 95% of the time, if I have a losing trade, it will be because I have a close below my end of bar stop. So I use 2 stops. I use an emergency stop and I use an end of bar stop. This emergency stop is down here in case just everything hits the fan and it goes down. Well, okay, I know. It goes down 23.42 shares. I am going to lose $1,000. I already did the math. But my end of bar stop is much, much closer. My end of bar stop, I bought here at 1181 with rejection at the bottom of the order block. If the next day it had simply closed below the low of this order block, I'd simply be out, right? All the way down here, I have a maximum loss at 1%. So if the next day it closed here below the low of the order block, maybe I lose 0.1%. If it goes further, maybe I lose 0.25%. It doesn't matter. Emergency stop, maximum loss, 1%. Anything other than that, it's less, right? Even if the next day it closed 1 penny below this order block, I simply would have been out of the trade. Okay, so we know why I entered the trade. Rejection of the bottom of the order block, my position size, I placed my emergency stop 2 ATRs below. I know where my end of bar stop is, simply a close below the order block. Excuse me. The next thing I do is I look for the value of the 1.5 ATR. Right, here we go. It's $40.07. I take my entry price. I add on top of my entry price the value of the 1.5 ATR, and I place the orange line up here. This is my trailing stop mode. All this means that when I take the trade, if it gets up here, now it's moved a significant amount. Now I want to tighten up my stops by going into trailing stop mode. And all trailing stop mode means is that in the future, if I get to trailing stop mode and I have a close below a previous bar's low, I'm going to sell half of the remaining position that I have. And what this does is it tightens everything up. If you're selling half, it essentially moves everything up. And that's what you're supposed to do. When a trade moves your way, you want to tighten up your stops. Well, my stops are all staying the same, but by selling half, by default, it's moving those up. I hope you understand that. Okay, now, everything I've talked about so far, the proper position sizing, placing the emergency stop, knowing where your end of bar stop is, placing your trailing stop mode and going into trailing stop mode and selling half if you have a close below previous bar's low after trailing stop mode. These are all defensive moves. In other words, if the market moves against me, I have to take a certain action defensively, right? But as with any good sports team, you need to play really good defense, which we are playing here, defense, but you also need to play offense. And in trading, I need to play offense as well. So how do I play offense? I play offense by taking partial profits each day if it moves a certain amount from the previous bar's close. So I am currently in this trade, and I will show you exactly for Monday where I am going to set my profit targets for Monday. So the first thing I do is I look at the closing price. Very simple. The closing price is $12.0465. Do you agree? Right here, $12.0465. Now I look for the value of the 0.45 ATR. Right now, the value of the 0.45 ATR is $12.02. So for Monday, I take the closing price of today plus the value of the 0.45 ATR, which is $12.02, plus $12.02. My first profit target for Monday is going to be $12.1667. So the question is, okay, if it gets to that profit target, how much do you take off? I take off 10% of whatever the amount of shares I have going into the day. If I have 100 shares going into the day and it gets to my first profit target, I take off 10%. I take off 10 shares, right? But I always set 3 profit targets per day. So closing price plus the value of the 0.45 ATR gives me my first profit target at 12.1667. Now I take the first profit target, 12.1667, and add the 0.45 to it again, plus 12.02. My second profit target for Monday is 12.2869. And again, if it gets there, I would sell another 10%, right? I sold 10 if I had 100 shares, first profit target, sell 10 shares, because that's 10% of 100. Second profit target, I would also sell an additional 10 shares. And I do it one more time. I take the second profit target, 1228.69 plus 1202, and my third profit target is 1240.71. So Monday, I will put these orders in, limit orders into the system. Monday, if it moves down, I don't hit any profit targets, right? Fine. But if it moves up a little, maybe I hit one profit target, right? I sell a little into strength. It's always important for me to sell a portion of my position if the market goes my way. So I I put three profit targets in the system each day. All right. So now that we have all that, let's just kind of play the trade out. So again, why did I enter the trade? Rejection of the bottom of the order block. I entered at 1181 even. I placed my position size correctly. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below this green order block. So it's very close. So if I'm wrong, I can be, I have the potential of being wrong very small. I placed my emergency stop 1.5 ATRs above, and the next day, right out of the gate, shoots right on up, which happens very often when you have a good entry on an order block. Now, I hit multiple profit targets on this day. So right out of the bat, I'm locking some in, right? Taking some risk off, locking some profits in. The market can't take that away from me. And I have fewer shares because it moved up. In addition to moving up, I also got to trailing stop mode, which doesn't mean I do anything at the moment. All it means is that now in the future, if I have a close below a previous bar's low, I'm going to get out of half. The next day, moves up again. I hit one profit target, right? So I'm continually reducing. The next day, moves up again, continually reducing. The next day, gaps open. I take another profit target off. But then we have a big reversal. And this is the first close below a previous bar's low after reaching trailing stop level. What do? I sell half of the remaining shares that I had. But you can see I was very glad to book at least one profit target up here before the big reversal. Would you agree? So I sold half of the remaining shares there for a gain of 1.95%. And by selling half, I tightened everything up. Next day, right up again, hit multiple profit targets, which is great, right? Next day here, up again. Next day here, I don't think I hit a profit target on that day. And then we had the big move down, and essentially here we're just going sideways. So the remaining shares, I sold half for a gain of 1.94%. The remaining shares on this trade currently up, that was 1.94%, and the current position, the remaining shares up 1.96%. So not a bad trade on Netflix. Again, this was the strategy here was the rejection of the bullish order block. So it was a order block trade. Okay, so the next trade is INDA. This is the Indian Stock Market ETF. Now, I entered INDA at 52.28 on the 11th of August. Why? So you can see the green block here. This is the order block. Order blocks, of course, are basically my favorite place to buy any trade. Now, this particular entry, it did not reject the high of the order block. It did not reject the low of the order block. So why did I take the trade? Well, this is a combination of two primary signals. The first signal is that we are in the order block. The second is that we created a bullish abandoned baby. You've heard me talk about these. I love abandoned babies. What is an abandoned baby? They're quite simple, but there's a lot going on underneath. If you look this bar here highlighted in blue, this is the abandoned baby. So what makes it an abandoned baby? The previous day, you can see we gapped down overnight. So overnight, the sentiment was negative. Whatever it was, I can't remember what it was, right? Probably something to do with tariffs, I would imagine. But we gapped down. So everybody was very bearish on INDA. However, the very next day, we magically gap up. And when you have a gap down, immediately followed by a gap up, systemically something has probably changed, right? We don't know what it is. I'm not that smart, but the chart is smart and tells me that sentiment was negative and followed quickly by a reversal in that sentiment to positive. So they call it an abandoned baby because this little bar is hanging out here by itself, down, up. So this by itself is a good signal, but it happened inside the bullish order block, which makes it a better signal. So I entered here 52.28. My emergency stop here is 2 ATRs, 51.39. On this particular signal, we had closed just over the 30 RSI. So there was an under 30, over 30 as well. My stop on this trade is if we were to close below a 30 RSI. Okay, I placed my trailing stop 1.5 ATRs above, and off we go. The next day, up nicely, hit a profit target. Next day, up again, another profit target. Next day, we closed below the previous bar's low, but no action is taken because I have not got to trailing stop level yet. Next day, right back up again, and then a huge day up here on the 18th, which goes above my trailing stop level, puts me in trailing stop mode. It doesn't mean I do anything, it just means that now I'm in trailing stop mode. So took profits here on this big day as it's moving up. Next day up a little bit more. The next day gaps open, hit another profit target. And then here on Thursday, we had our first close below a previous bar's low. So what do? I sell half of the remaining shares that I have left on that particular day. And so I sold half for a gain of 2.43%. And then yesterday was basically almost break even. So again, why did I take the trade? We have a bullish abandoned baby. We have an under 30, over 30 inside of a bullish order block. So for me, the most profitable and most consistent trades that I have are the ones where I'm very patient. I wait for movement generally inside of the order block and then look for other supporting signals inside the order block. V1, a bullish V1, a bullish V2, an abandoned baby, an under 30, over 30, a rejection of some type of major moving average. But when you combine the order blocks with these other signals, they are very strong. So the remaining shares that I have on India up 2.43%. Okay, let's go to Adobe. All right, I'd like to thank my my friend and student Vivek from Canada. He pointed out to me this trade. I was watching Adobe, but I was watching Adobe on the weekly time frame instead of the daily time frame. And so Vivek said, Greg, it looks like a pretty good signal. I'm like, oh, yeah, I didn't even notice it. You're right. So what was the signal? The signal is, oh, sorry. The signal is we rejected, here's the order block, the high and the low of the order block. This is a very wide green order block, but we rejected the bottom of the order block. During the day, we went below it. We closed back in the order block. That is the primary signal. There are some nice secondary signals here as well. Here's it on the day that it triggered the entry, it also triggered a V1. A V1 consists of two bars, bar 1, bar 2. Bar 2 goes below bar 1's low, closes above bar 1's close. If you want to learn more about V1s, V2s, just go to my YouTube channel. I have a video on those. In addition to that, we rejected the negative third ATR channel. You can see this gray line. This is the negative third ATR channel. 92% of prices, when they get to the negative third ATR channel, stop going down, start to move sideways, or move up. So when anything when any market gets to the negative third ATR channel, it's worth a look because statistically that's usually where it bounces. But I need a rejection. Well, there was a rejection. The previous day we closed under the negative third ATR channel. On the day that I took the trade, we closed above the negative third ATR channel. So the primary signal was a rejection of the bottom of the green order block. The secondary signals were the V1 and the rejection of the negative third ATR channel. So I entered here 336.07. I position size as always. I placed my emergency stop how far below? 2 ATRs, right? Where is my end of bar stop? My end of bar stop is simply a close below the low of this green order block. If the next day it had gone below and closed there, I simply would have gotten out, very likely for a small trade. You can see on the day that I entered the trade, it went below and then closed above. So I entered here 336.07. I position size correctly. My emergency stop is 2 ATRs below. My end of bar stop is a close below the low of the order block. I place my trailing stop level 1.5 ATRs above my entry. And the next day, straight up, right? Of course, that's exactly the kind of trades that you want, that you take and they immediately go your way. The best trades in the world are the ones that immediately go your way. And by using these confluences with the order blocks, you get them all the time. Not all the time, but a majority of the time, if it's the right signal, the market will see it and take off. Not every single time, but more times than not. So you can see the next day, boom, immediately up. I hit multiple profit targets on the way up. I also got to trailing stop level. Now I'm in trailing stop mode. Next day didn't do much, down a little. Next day up, where I again hit a profit target. I'm in trailing stop mode, but no close below previous bar's low. Next day up a little, not enough for a profit target. The next day up again, profit target. And then here on the 20th of August, we have our first close below a previous bar's low after reaching trailing stop level. What do I need to do there? I need to take off half of the remaining shares that I had, and I did that for a gain of 4.86. Now, I sold half. Selling half is one of the only win-win situations in trading, because if you sell half and it goes down, you are happy that you sold half higher. If you sell half and it goes up, you are happy that you still have half, right? And of course, I am glad that I kept half of the trade. So I locked in half for a gain of 4.86%, and the remaining shares that I have currently up 7.09%. So nice trade on Adobe. Okay, Microsoft. I entered Microsoft on Thursday at 504.11. Why did I do this? Well, here is an order block. Now, again, I'll point this out. What makes an order block? A swing low, followed by a swing high, followed by a lower swing low, and then you need to take out that first swing high, which happens here, which turns the structure into a bullish market structure. Now, do I buy the breakout? No. But when the breakout happens, it defines the order block. Now, if it defines the order block, I am just waiting for a pullback into the order block. Or in other words, I'm waiting for a pullback into the smart money area. When we were here, clearly people buying here was smart money. Does it mean if it comes back to this level, it's going to be smart money again? No. 100% it does not have to be smart money again in the future. But more times than not, it is. So I waited patiently. For Thursday, I entered at 504.11. Why here? Well, look at the 50-day moving average. This is a gray line. It is running through the order block. I can take trades inside the order block if there's a moving average inside, if I have a V1, if I have an abandoned baby. It's not just a rejection of the high of the order block or the low of the order block. It can be inside. But on the day that I purchased it here on 8/21, number one, we're in the order block, and number two, on an end of day basis, we went below the 50-day moving average and closed back above it. So that is why I entered the trade at 504.11. I position size, as I always do, correctly based upon the volatility. I place my emergency stop, as always, 2 ATRs below. And now, where is my end of bar stop? My end of bar stop is simply a close below this 50-day moving average. You see how close my stop is, my end of bar stop is? Well, it moved up on Friday. I did hit a profit target, which was great right off at the bat, and we closed above the 50, so I kept the trade, right? So currently the remaining shares on Microsoft, not up a lot, up 0.57%, but not bad in one day. But again, my end of bar stop is simply going to be a close below this 50-day moving average. If it closes below, boom, I'm out. I can always get back in if it reclaims the 50-day moving average in the future. All right, so the remaining shares here on Microsoft up 0.57%. Okay, Love. Really good trade on Love. Like to thank my student Carlos. Carlos and I were discussing Love during one of his lessons last week, and this is what kind of got me interested to look at Love a little closer than I normally would have, because he had taken the trade on Love, and I said, I quite like it. So I did enter Love on Thursday, the 21st of August at 31.08. Why? Well, here we have an order block. In addition to the order block, do you see the purple line in the middle? This is the 250-day moving average. So I took the trade on Thursday at 31.08 because two confluences, two primary signals. The first signal was we had an intraday rejection of the 250-day moving average, the purple line. We went below it during the day, closed above it at the end of the day. So it tested all the areas below this 250-day during the day. It did not like them. There were not enough sellers to keep it down, and it moved up. In addition to that, in addition to the intraday rejection of the 250, it also rejected the high of this order block. During the day, it was below it. It closed above it, right? So I entered the trade 31.08. Position size correctly, place my emergency stop 2 ATRs below. Where do you think my end of bar stop is on this trade, if you had to guess? Is it the low of the order block? No. It's a close below the 250-day moving average. You see how close I am to that to begin with? If the next day, if Friday, it just closed 1 penny below, okay, I take it off. It's a loss. It's fine. There's cost of doing business in every business. Your cost of doing business in trading are your losses. But as in any business, you want to keep your losses small and have the most revenue. Well, in my business, in the trading business, winning trades is your revenue, losses your expenses. I want to keep my expenses low. So that's why I have a good risk to reward ratio, right? So I entered the trade 31.08, and then of course yesterday, huge move up 5.47%. Of course, I hit multiple profit targets on this explosion of a day up, and also I am now in trailing stop mode, which is always great. I love getting to trailing stop mode because if you get to trailing stop mode, you're above your entry by 1.5%, right? So it's a good feeling. And now, because I'm in trailing stop mode, I just know in the future, if I have a close below previous bar's low, I'm going to get out of half. So this was a great trade right off the bat. And this particular trade at the moment is up 5.19% in one day. So again, you can see the power of using the order blocks in combination with these deep dip buy signals. Deep dip buy signals are rejections of 200 SMA, 250 SMA, 300 SMA, under 30, over 30s. These are all deep dip buy signals. So this was a really, really good trade. And by the way, I do teach private lessons. I teach people all over the world. I teach a 20-hour one-on-one course, and I teach you all the different strategies that I use. I teach you every single rule, why we have it, why we used it. I have turned out so many great traders over the years, like I said, in all areas of the world. And if you would like to do this 20-hour course with me, I would love to have you as a student. I will teach you everything I know. My email is in the link of this YouTube video. All you have to do is reach out to me. And usually we just have a first kind of get to know you video call, just make sure that we're the right fit. But I would love to have you as a student. I'll teach you everything that I know, and you will have a skill that you can use the rest of your life. So love, nicely up 5.19% right out of the get-go. Okay, last on the dailies is CRM. I've talked a lot about order blocks. I've talked a lot about deep dip buys. One of my other favorite approaches and setups, I haven't had a lot of them lately, and I've asked people, Greg, do you not trade higher low V1s, V2s anymore? I'm like, yes, I absolutely do. I would trade it every day if I had one. But in the current market condition, I just haven't had them. I had one a month ago or something like that on Etsy, really nice one. But I was glad to see on CRM a higher low V2 that I took on Friday. So what is a higher low V2? Let me first draw your attention to these two green lines, the top green line and the bottom green line. This is what is called the value zone. You have the 1 ATR and the negative 1 ATR. Anything within the two green lines is called the value zone. So the first requirement for a higher low V1, V2 is we have to close below the negative 1 ATR channel. You can see here clearly we close below the 1 ATR channel. The second requirement is that you need to come back into the value zone. Well, that happened as well. The third requirement is we need a pullback, and then we need a V1 or a V2 to trigger that closes inside of the value zone. Well, on Friday, this happened. This is a V2. A V2 now, I talked about V1 consists of 2 bars. A V2 consists of 3 bars. Bar 1, bar 2, bar 3. Bar 2 has to go below bar 1's low. Did bar 2 go below bar 1's low? Certainly did. Did bar 3 close above bar 1's close? Absolutely it did. Did it close in the value zone? Yes. Is this low higher than this low? It certainly is. That is why it is called a higher low V1, V2. And higher low V1s, V2s, the reason I like these so much, these are very often the very beginning of a new leg up. All right. So here's the higher low V1, V2. I entered at 247.90. I positioned size correctly. I placed my emergency stop 2 ATRs below. Now on a higher low V1, V2, where is my end of bar stop, right? I don't have an order block here. I don't have a major moving average to key off of. It's very simple. When you take a V1 or a V2, my stop is a close below halfway of bar 2. Bar 2 is called the washout bar because it goes below or washes out bar 1. So here is my line in the sand on my end of bar stop is 243. If Monday this goes down and closes, keyword being closes below halfway of this bar, I'm simply out. So you can see my risk on this trade is pretty close. Of course, I always have my emergency stop down here in case everything hits the fan, right? But, tests have been run on V1s, V2s. In the future, if it closes below halfway the washout bar, more times than not, it's going to continue lower. But if it does not close below halfway the washout bar, more times than not, it's going to go higher. So I just entered this trade, basically break even. And again, I entered higher low V1, V2, placed my emergency stop 2 ATRs below. My end of bar stop is a close below halfway of the washout bar. I placed my 1.5 ATR trailing stop level above. And Going forward on Monday, if it moves up, I'll continue. I'll take profit targets. Monday, if it closes below halfway, I'll get out. Right? I have no control over this trade. I have total control when it comes to how many shares I'm going to buy, if I'm going to get in the trade, where I place my emergency stop, where I place trailing stop. That I have all the control in the world over that. But once the market opens on Monday, I have no control. I need to know exactly what I am going to do regardless of what the market does. If then statements. If it does this, then I'm going to do that. If it does that, then I'm going to do this. You need to know this exactly on every single trade that you have. What am I going to do? I don't care what this does. I know what I'm going to do. And I know I got into a good statistical trade that not 100% of the time is going to make money. Certainly not. I wish. But more times than not, it will. If I took this setup 100 times, most likely I would have a winning trade 70 times out of 100, which means there are going to be 30 times out of 100 that I'm going to have a losing trade, right? It's just guaranteed. But you have to structure this trade so that the 70 times that you do make money, you make more money than you lose 30% of the time. And that's why we have good risk to reward ratios and so forth, right? So anyway, I was glad that I saw this trade. I'm glad that I took it and that I could share it with you here. But yes, I absolutely would take every higher low V1 or V2 if it was valid in the future. I love these trades. So we'll see how this plays out. Okay, so those are all the, excuse me, I had this cough. These are all the open trades. Now let's go to the trades that I closed on Friday. Okay, so I closed Google, the short trade, for a loss. Now, why did I take this trade? Well, we talk about order blocks, the green bullish order blocks. Well, there is also such things as bearish order blocks. And on Google, we had this order block here. The reason that I took the trade on the 18th of August was because we went above the high of the order block and closed below the order block, right? Just like I take a long trade if it rejects the bottom of the order block, I'm going to take a short trade if it rejects the high of the bearish order block. So I got short here 203.60. I position size the same way as I do for long. I place my emergency stop 2 ATRs above. I place my trailing stop level because I'm short 1.5 ATRs below. And my end of bar stop is just simply a close above the high of the order block. So I got short here 203.60. The next day, moved down, went my way, took some profits, which being that it rallied back on me is important, right? Because I did book some profits on a partial part of the position and I reduced my overall position size. The next day, down again, which is great because I took, again, some of the shares off when it was going my way. And then Thursday was kind of a nothing burger. It was up a little bit. But Friday, of course, we had the big rally. And what did it do? It closed above the high of the order block. So that's my end of bar stop. I had to get out. So was it a loss? 100% it was a loss. Was it a big loss? Not really. 1.28%. And in addition, because I take partial profits, I play offense, that mitigated that loss. But didn't work. But the key is that I kept the loss small, 1.28% loss. I am now out of the short on Google. Intel. Intel was a great trade, and I will share with you why I entered the trade. Entered the trade all the way back here on the 4th of August. Why? Two primary signals. Here we have the order block, the high and the low of the green box. The previous day we closed below the order block, and we also closed below the 30 RSI. On the day that I took the trade here at 1943, we closed above the low of the order block. So it was a rejection of the low of the order block. That is a primary bullish signal. And we also closed above the 30 RSI. That is a deep dip buy signal, under 30, over 30. So we had them happen at the same time, and we had the under 30, over 30 close back in the order block. That's even better. So rejection of the bottom of the order block and an under 30, over 30 in the order block, two strong primary signals. I entered at 1943. I position size correctly. I placed my emergency stop, as always, 2 ATRs below. My end of bar stop is simply a close below the green order block. Look how close I am to it already. If the next day it had closed 1 penny, 5 pennies, 20 cents, I just get out for a very, very small loss. Okay? So, as soon as I enter 1943, I place my trailing stop level 1.5 ATRs above, and if it starts moving up, I start taking profits. Next day, right out of the gate, up nicely, took some profits off. This line moved and got to I got to trailing stop mode on this day. I wish I wouldn't have, but I did. I got to trailing stop mode here, so now I'm in trailing stop mode. And then here on the 7th was the first close below the previous bar's low after reaching trailing stop level. What did I have to do? Well, my rules tell me I have to sell half, which I did for a gain of 1.92%. The next day, up, profit targets. Next day, up, multiple profit targets. Next day, up again, profit targets. Next day, up again. I can't remember if I had a profit target there. Next day, up here, massive profit targets. Next day, up again, had a huge gap up and reversal. I sold half of the remaining shares that I had there for a gain of 20.77%. Why? Well, on this day, we went above the 70 during the day, and we closed below the 70 RSI at the end of the day. That is my signal to sell half of the remaining shares that I have, and I did for a gain of 20.77. I exited until fully the very next day, because additional rule is once I reject the 70 RSI, then in the future, if I have a close below a previous bar's low, that is where I exit the entire remaining shares, and I exited the remainder for a gain of 17.75%. And then it went racing up, and I was like, shoot, that's okay. And then it came down, and I was like, that's about the same place as I got out. And then on Friday, of course, we had the big up move. But really great trade, really good example of using an order block and an under 30, over 30 deep dip buy combination with an extremely good risk to reward ratio that turned into a monster trade. So on the 18th, I exited the remaining shares of Intel for a gain of 17.75%. Okay, UNG. I also closed out UNG. I entered UNG on the 14th of August. Rejection of the bottom of the green order block, plus a V1, plus a rejection of the negative third ATR channel. I got long 12.51. Next day, moved up. I hit multiple profit targets, which was great. Next day, down, closed below the previous bar's low, but I had not got to trailing stop level yet. And then, boom, collapsed and closed under my end of bar stop. So I took a loss on UNG for a loss of 2.8%. UNG has been a tough one to find a bottom, but my rules tell me under the order block, get out. Can't win every trade. And so it took a loss of 2.8%. So those are all the open and daily positions. Let's quickly look at the weekly positions. Weekly bars close on Friday. I take the trades on Friday on the weeklies. So I entered UUP back here on the 11th of July. Multiple signals, close under, close over the 200-week moving average. That's a deep dip buy. In addition, the bar that I took it, the previous bar, we were in the order block, closed above the order block. So we had two primary signals, rejection of the high of the order block, rejection of the 200-week moving average. I got long here 27.21. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 200-week moving average. I placed my trailing stop level 1.5 ATRs above. The next week moved up, hit some profit targets, which was nice. Next week down. Next week big ups, where I hit multiple profit targets and also got into trailing stop level, right? Or trailing stop mode. Next week down. Next week was the first close below a previous bar's low after reaching trailing stop level. I locked in half of the position for a gain of 0.51%. Now, this is a currency, so you're not going to see the huge percentage gains. And then this week, during the week, I did hit a profit target, and then it reversed. So the remaining shares here on UUP, not a big gain, but the remaining shares up 0.44. Let's go to XLV. If you have been watching this channel for the last month and a half, 2 months, you will remember that I have been waiting very patiently for XLV. XLV is a healthcare ETF. I started talking about XLV in this area. We have a bullish green weekly order block below. We also have a 300-week moving average right in the middle. And I said what I'm really looking for, and just going to be patient, I'm looking for a pullback and bounce at that 300-day moving average inside the order block. Well, I waited, and patience was a virtue, because I entered XLV here on the 8th of August at $130.07. What were the signals? There were two primary signals. We rejected the high of the rejected the high of the order block, and we also bounced and rejected the 300-day moving average. I got long 130.07. I placed my trailing stop level 1.5 ATRs above. Right out of the gate, took off after that signal. Hit multiple profit targets, which was great. This week, also another profit target, and also now I'm in trailing stop mode because I got 1.5 ATRs above. So really good trade. The remaining shares I have on XLV currently up 5.9%. And you know what's great about this particular trade is once I got in, it just went straight up. And to me, in my opinion, that's just a function of being very patient and waiting for those two strong primary signals. So up 5.9% on XLV. TLT, okay. I've been in this trade for 187 years. So I'm going to be quick on this. Actually, I got in the trade on the 17th of January. Why? Rejection of the high of the order block. I got long 87.20. Placed my 1.5 ATRs trailing stop level above. I placed my emergency stop 2 ATRs below. My end of bar stop is a close below the low of the order block. For weeks and weeks, we went up and up and up. I took profit targets, of course, as always. On this particular bar, this particular week, hit a lot of profit targets. Also got to trailing stop mode, which was great. Moved sideways for a month, up again. Of course, I took partial profits, which obviously is important, being that we've gone down since then. Then we had the big move down, the problem with the yen and with interest rates. I had my first close below a previous bar's low after reaching trailing stop level. Had to take a little loss of 0.58%. But again, remember, I took partial profits all the way up. Next couple weeks went up, profit target. Next week went up, profit target. Next week went up, profit target. Then we had a month worth of down. I stayed in the trade because we have not closed below the order block. And from here, we've just kind of moved sideways, a little up, a little down. Every once in a while, I took a profit target. This particular trade, out of all this time, the remaining shares down 0.26%. But I have gotten 8 months of dividends on this trade as well, right? So the remaining shares, kind of a nothing burger, down to 0.26%. But you can see why it's important to take the profits when you have them, because if this happens and then you start going down, you mitigate your losses and you've locked in partials when the market was good. And that's why I'm such a big fan of taking partial profits when the market gives them to you. Okay, I've been talking for 500 years here. Let's go to the last weekly trade. The last weekly trade was a short on Amazon. Why a short? Well, you see the red box. This is a bearish order block. Well, why is it a bearish order block? Because we have the exact opposite of what a bullish order block is. We have a swing high, followed by a swing low, a higher swing high, followed by market structure change, which defines the order block, the bearish order block. I entered the trade here on the 15th of August. Why? Well, we had a big down bar all the way here on the 7th of February. If you have a big down bar and then you rally into half of that big bar, there's going to be inherent resistance there. And that inherent resistance at the halfway down bar also lives inside the bearish order block. So that is why I took the short trade here when we rejected the halfway, which is the red line of that down bar. I got short here 230.90. My end of bar stop is just as simply a close over 230.70, which is halfway at the big down bar. And then, of course, I have my 2 ATR stop up here as always. So it started off down, but then we had the big reversal back on Friday. But still, this particular trade is up on the short trade, up 1.07%. So those are all the trades that I have. Dailies, weeklies, open trades, closed trades, all sorts of different entries, order blocks, deep dip buys, higher low V1s, V2s, abandoned babies, all the tools that I use. So I think this was a good example of multiple signals with all the different tools that I use. And you can see, not every trade was a winning trade, but what was the common denominator? The common denominator was my winning trades were larger than my losing trades. Another common denominator is the trades that were profitable, I've been in for a certain length of time. The trades that I was negative on, I'm out quickly. Really, it comes down to being patient with your winning trades and being very impatient with your losing trades. And what I just showed you there, the winning trades, I'm in much longer than the losing trades. And that's really the key. So, okay, before we get on to next week's potential trades, let's talk a little bit about trader psychology. Won't be long, but hopefully it will be helpful. Okay, so this is from my good friend Stephen Burns. I've talked about this before in my podcast, but I've always liked this this diagram here. There are different aspects to trading. It's not just entry. There are many things going on. We need to have discipline, right? Absolutely, you need to have discipline and patience to wait for the trade, to wait for your trade, wait for a proper setup. You need good signals. Okay, signals, V1s, V2s, abandoned babies, rejections of moving averages, so forth and so on. Position sizing. Of course, we need to position size. You can have the best setup in the world, but if you position size too large and if the trade goes against you, it's horrible, right? You could lose a lot of money. And then price action. So what's the difference between price action and good signals? Well, the way that I view this is like order blocks or context. The context of what the trade is doing. Contextually, if I switch from a bearish structure to a bullish structure, now the context of the market is bullish, and therefore I want to look for buying signals. If the context of the market is bearish, then I want to look for selling signals or selling entry signals, right? So, and they all overlap. And you have to have all of these. You have to be well-rounded in your trading. It's not just about signals. It's about price action or context. Is the chart bearish or bullish. On top of that, then you have to enter in your actual entry signals, V1s, V2s, deep dip buys, right? The signals inside of the context. You have to wait for these to happen, which is your discipline. And then, of course, you have to position size correctly. So there's a lot of overlapping things. It's very multi-dimensional. And I think a lot of beginning traders don't realize that. They just kind of concentrate on, well, there's an entry, just okay, it's an entry, but was it an entry in the context of good, market structure? And did you position size? And of course, did you wait for the trade to come to you and have the discipline? So good signals, proper position sizing, price action, and discipline. If you overlap all these in the middle, there in the middle, there's your profit. But it takes all four of these always consistently blending them together to get the prize, right? So thank you, Steve Burns. Please follow Steve Burns over on Twitter or X at @SJosephBurns. He's a great trader, a great author. Check out his books on Amazon. Read every single one of them. You're going to learn a lot, I promise you. So, okay, let's get to next week's potential trades. I couldn't find any on the weekly time frame. I went through them all. I could not find one. So these are only dailies. So here I have 8 potential trades for next week. Now I mention this always. 8 potential signals. Is it possible on Monday all 8 of these trigger? Yes, it is. Does that mean I would take all 8 signals? Absolutely not. I only take 1 trade per day or 1 trade per time frame. Even if 8 of them trigger, I need to narrow all 8 down to the best one. How do I do that? Basically, I give it a scorecard. If one stock has 1 signal and the other has 2 signals, which one do you think I'm going to take? I'm going to take the one that has more signals. So I look at confluence combination of signals. I have to factor in what is the risk to reward ratio. I could have a great signal but a bad risk to reward ratio, so I have to factor that in. I have to look at multiple time frames. If I'm looking on the daily, I want to take a quick glance at the weekly to see if there's any support or any additional confirming signals on the weekly. I need to look at relative strength. Maybe the market is down, but this particular entry signal, that market is up. Well, that helps because that is relative to the rest of the market, it's stronger. So that helps me look at things. So, I need to look at many different things, and I essentially give it a report card, and I will take the one with the highest score. This is what I teach all my students, how to differentiate, how to narrow down to the best trade. There's other things too, right? We have bullish MACD divergences, ATR divergences, RSI divergences that help us pick the best one. And again, this is what I teach in my one-on-one course. I would love to have you as a student. We'll spend 20 hours together. We'll get to know each other well. But like I said, I'll teach you everything that I know, and you will have a skill. So my email's in the link. Please send me an email. We can get the process started. As an alternative to the one-on-one course, I do have a really good online video available at udemy.com where I teach you step-by-step the deep dip buy trading approach, right? Not all the different ones that I use, but this particular video is just a deep dip buy. But it's very thorough video. It's 9.5 hours of me teaching you step by step the deep dip buy strategy. It's a great course. I've sold so many all around the world. It has like a 4.85 star rating, so that's a good place to get started. Of course, the bigger jump is doing the one-on-one course with me, which is, it's going to be better because it's one-on-one and you can ask questions and so forth. But either way, the video course or the one-on-one course, I'd love to have you as a student one way or the other. And just please reach out. So, okay, here is Apple. Now, Not a lot of potential signals this week. You know, a few weeks ago, I had all those, the good trades that I've had this week, those were all in the right areas, in the right zones. Now, not as many. So we have to be a little bit more patient. So if we look at Apple here, okay, we have a nice order block down here. Very wide order block, you can see. But what are the chances we're going to get down to this order block? Not likely. I mean, it's possible, but if it did, just a few different ways to look at Apple, I would look for rejection of the 50-day moving average, which is the gray line inside the order block. That certainly would be one level for sure to key off of. Another level, even better level, would be this 100-day moving average inside the order block. But, you know, is it realistic that we're going to come down here? No, it's possible, but it's not realistic. So at this moment, probably the most realistic level for potential trade on Apple would be here. We have the 250-day moving average, we have the 300-day moving average, which is the orange line, and then of course we have the black 200-day moving average. Right in all three of those are nesting in this area right here, not in an order block. Order block makes it better, but just a deep dip by itself is completely legitimate also. So I will be looking next week on Apple for some kind of rejection of the purple line, which is the 250, or rejection of the 300, which is the orange, or the 200, which is the black. But what I do like about the major moving averages here at the moment, it doesn't happen very often, but all of these major moving averages are sitting inside of the value zone, which I like. It's not the order block, but it's almost like the second best thing, being inside of the values, having the major moving averages inside of the value zone. So I will be looking for a rejection of the 200, 300, or the 250 next week on Apple. And the other nice thing about these three moving averages is they're kind of at the low of this big explosion up bar. There's going to be a lot of support in this area because that was that big impulsive explosion up bar, and that dovetails with the support of the major moving averages here. So I'll just see. Maybe it just keeps going up. Not going to get the trade. But if we do come down, have some kind of rejection of the 200, 300, or 250, potentially, if it gives me a good risk reward, I could potentially enter there. Alibaba, BABA. Okay, so this in red is an abandoned baby, a bearish abandoned baby. Why is it an abandoned baby? Because we gapped up, everybody loved it, and then immediately we gapped back down. That is bearish. And was it correct bearish? Yeah, it was. For over a week, that was bearish. But we had the big rally on Friday, but I'll tell you, on an abandoned baby, the key level of an abandoned baby resistance level is the bottom of the baby, the bottom of this bar. That's why I drew the red line here. This is going to be key resistance. And next week, if we continue up and reject the bottom of this abandoned baby, meaning we go above it and then reject it and close back below it, very likely I would take a short position there. And on abandoned baby short positions, if I enter, I would place a 2 ATR stop above and a 4 ATR profit target below. And that would be basically the trade. And I would just let it play itself out. I'm either going to lose 2 ATRs or I'm going to make 4 ATRs. But this is going to be a major resistance level here at 125.08. So I'm looking for rejection of the bottom of that level for a short position. Energy Transfer. Okay, I've been watching this for a while, for a couple weeks. We have a beautiful order block here. And inside of the order block, we have the 250-day moving average, which is the purple line, right? Just my favorite setups, having a major moving average inside a bullish order block. We have not got down to it. Here we got pretty close. I was looking to buy here, but we just didn't quite get it. And you can see it did bounce from that area. But really, that's what I'm looking for. The 250-day moving average inside the bullish order block. We also have the 100-day moving average, the red line, very close to the 250. If we rejected one of those levels, I would certainly consider getting long ET at those levels. IBM, probably my favorite setup at the moment, but we're not there yet. We have a beautiful order block on IBM. Let's see, right here. This order block started 420, 425. We have a swing low, then we have a swing high, and then we have a swing low. We break market structure to the upside. Again, if you look here at the very top, a couple months ago, in context, if you look here, was this order block area a smart money? Were people that were buying here, was it smart money? Well, yeah, of course it was. In hindsight, of course it was. So this is the smart money area going into the future. Now, if we get back down to where the previous smart money area, does that mean it's smart money area again? No, not necessarily, but there's a better chance, right? And what I love about this trade is we have the 300-day moving average deep dip buy inside of this bullish order block. So there are two major confluences of signals here. And this is where the patience comes in. Maybe it takes off and just goes back up. And if it does, that's fine. But if next week, for whatever reason, we come down, maybe it's not next week, maybe it's the week after, maybe it's the week after that. But if we come down and we reject that 300-day moving inside the order block, really good setup with a much higher likelihood of going higher than lower from there, right? So I'm just going to be patient, wait for that 300-day moving average, maybe even a rejection of the high of the order block, I would consider, depending on the risk to reward. And if I took that, then I would use the 300 as my stop. But ideally, in a perfect world, move down, rejection of the 300-day moving average inside the order block, take the trade, really good risk to reward ratio. Coca-Cola, KO. Okay, so Coca-Cola has this bullish order block here in the green. And I've talked about this. I've never been able to take the trade because every single time we get into the order block, we bounce. Into the order block, we bounce. Into the order block, we bounce, right? So what I really ideally am looking for on Coca-Cola, I don't think it's likely that it's going to get there, but if it does, then I will probably take action. We have the deep dip buy, 250-day moving average, 200-day moving average, 300-day moving average, all here in this similar area inside the order block. This would be the level that I would be interested in getting in, but only if it gets there, right? You have to look at a chart and go, ideally, that is where I want. If it doesn't get there, don't mess with it. If it does, then you have your trade. Okay, so Netflix, I am currently in Netflix. However, I wanted to show you this. So I based my trade here off of this green order block. But order blocks are always shifting. They're always changing. New ones are being created. And although I based my trade on this green order block, in this blue box, this is a new order block. Why is it a new order block? Well, because look over here. We have a swing low. We have a swing high, we have a lower swing low, we have a market structure change. When you have the market structure change, you look for the lowest bar close before market structure change. Here you go. Now, in this new order block, what's living in the new order block? This upward sloping 100-day moving average in red. That's a perfect entry signal. Now, I'm already in the trade, but I can tell you that this coming week, if we close under the order block, of course, that's my stop. I have to get out. However, if it does close under the order block, go lower and then rejects the 100-day moving average inside this new order block, I would take the position again. But if I was not in this trade, I would be carefully looking and monitoring for this red line, the 100-day moving average in the new order block, because we shifted. We were in a downtrend, obviously. Now we have changed market structure to the upside. When you change market structure to the upside, what do I want to do? I want to look to buy dips. And that 100-day moving average is perfect inside the new order block. WES, also been looking at this for several weeks, have not been able to get there, but it's a beautiful order block. What's living inside the order block? Well, right here at the top is the 200-day moving average, the black line. We have the purple line, which is the 250. We have the orange line, which is the 300. All legitimate levels to key off of with some kind of rejections of those levels because they live in the order block. So is it going to get there? I don't know. If it does, I will certainly consider. And then last but not least, I was actually really surprised, but on Walmart here, because Walmart was just straight up, straight up, straight up, straight up. But there is a very nice looking confluence here on Walmart. If you are patient, we have this beautiful order block all the way down here, and we have the 200-day moving average at the bottom in the order block. That is a strong key level. Doesn't mean it has to be positive, or if you take the trade, it's going to be positive. But the stars are lining up right there. So I don't know if it's going to get there. But again, order block over here, a month later, looking back in time, when it's up here, was that smart money buying here? Yeah, of course it was. So taking that smart money level into the future, will it be smart money again? I don't know, but probably more likely. And in addition to the order block, we have the 200-day moving average, which by itself is a major level. So that's what I'm looking at, everybody. I hope today was helpful. If it was, I really would appreciate it if you could hit the thumbs up button. I appreciate your time, and I hope you have a really good rest of your weekend. I always like to leave off with, please try to go out and do something nice for someone. If you could do one nice thing for another human being every day, and everybody in the world did that, man, the world would be a better place, and we certainly need it. If you have it in your heart, if you could do one nice thing for an animal every day, they appreciate acts of kindness just like we do. But I'd love to help you with your trading. I would love to be your teacher and mentor, coach through my 20-hour course. So if you're interested, please reach out. If you have any comments or questions about anything I mentioned here on the podcast today, put them in the comments section. I will do my best to get back to you. But thank you so much, everyone. Enjoy the rest of your weekend, and God willing, I will see you next week. Thanks so much, everyone. Take care. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.